Welcome back to our channel. Today we are going to talk about what are the factors that can affect the currency value. Our currency's value is a basic fundamental component of our wealth and our ability to purchase goods, especially in this age of globalization. And today in this video we will examine some of these leading factors that influence the variations and fluctuations in the currency value. You must have thought, what are the factors that affect rupee against dollar and why there is so much fluctuation? So we are going to list all the factors to make you understand. First of all, it is due to the Indian foreign exchange reserve, which is increasing in the last few years. There is also the external factor of the dollar, which causes the rupee to depreciate when the US currency gains strength against the euro and vice versa. The daily fluctuation in foreign portfolio investment flow is also one of the factors which affects rupee against dollar. Moving on, there is the real effective exchange rate or price power parity, a theory used by economists that takes relative inflation into account. If India's inflation rate is higher than that of the nations whose currencies make up its export basket, the rupee is overvalued and will fall in value as a result. It is also important when the RBI would intervene to stabilize the Indian rupee by buying or selling dollars. Moreover, there are some fundamental factors also which indicate strength or weakness of currency, such as interest rate, inflation, economic growth, current account balance, and others. We will study all of these factors in detail. So let's start with interest rate. The country's interest rate is the primary element influencing a currency's overall strength or weakness. The cost of borrowing money is simply expressed as interest rate. The central bank of a nation can raise or lower the interest rate level to speed up or slow down the economy, while lower interest rates reduces the cost of borrowing money and therefore encourage greater borrowing or access to cheap credit, as you may call, in an economy. Higher interest rates make borrowing money more expensive. But when it comes to demand for a specific currency, a higher interest rate typically indicates a higher level of demand. Lower interest rates typically lead to a decline in currency demand. Investors seek for currencies with higher interest rates, since doing so increases their rate of return on currency exchange. The US economy and the Federal Reserve's monetary policy both influence the value of the dollar. The Federal Reserve's recent statement that it will increase its policy rate of funds in the future was sufficient to make the dollar stronger and the rupee weaker. The dollar increased in relative worth because rising US interest rates could cause foreign capital to flow back to the US. Given the stronger US economy and the Fed's recent support, the dollar should be rising. Meanwhile, RBI is also increasing interest rates to make Indian rupee stronger. Now let's look at how inflation comes into play and affects the rupee against dollar. The currency exchange rates fluctuate as a result of changes in market inflation. The value of a nation's currency will rise if its inflation rate is lower than that of another. Where inflation is low, prices of products and services rise more slowly. While a nation with higher inflation normally experiences currency depreciation and higher interest rates, a nation with lower inflation generally sees its currency appreciate. Economic growth is another factor. The value of currency rises with strong GDP growth, improving exchange rates and vice versa. The state of the economy or its performance is another element that affects exchange rates. For instance, a nation with low unemployment means its citizens have more disposable income, which promotes the growth of a more healthy economy. More foreign investment is attracted by a stronger economy, which lowers inflation and boosts the country's currency exchange rate. The current account balance is the last item on our list. It is regarded as the broadest indicator of a country's cross-border trade. Simply expressed, it is the sum of all of a country's exports, imports, revenue, and current transfers to and from its trade partners. A country's current account balance indicates whether it lends or borrows more from its trading partners. A positive current account balance indicates that a country lends more to its trade partners than it borrows. If there is greater demand from other countries for the goods and currency of that country, the total quantity of commerce may have a positive impact on the country's exchange rate. A deficit or borrower nation will see decreased demand for its own domestic products and currency. We have covered up almost all the factors that affect the currency value. However, we must tell you that currently rising international commodity costs, increased geopolitical unpredictability, fast rising international interest rates, and a slowdown in global demand, etc. These all have contributed to the rupee's recent depreciation. And the government's recent limitations on the export of certain commodities could potentially lead to weakening of rupee. We hope that this video has given you a better understanding of the topic. Do let us know in the comment section what you think about it. And don't forget to like and share this video. And if you are new to our channel, do hit the subscribe button and press the bell icon to not miss any updates. Thank you so much for watching.